Good morning, everybody that is joining us across Australia today for our latest national Zoom. If I haven't met you before, my name's Steve Mabb. I'm the current chair of ASA. We try to do these national Zooms from time to time each month, giving you a chance to learn a little bit, to engage with other members, and to put your questions to our speakers or our experts that we come and have present in these sessions. As always, we're not giving you any personal advice today. This is just general advice, and you should seek the opinion of a licensed financial advisor if you intend to take any action from things we talk about today. We're very fortunate to have one of our ASA education partners joining us today to present a really interesting and important topic. That's Chris Leithner from Leithner & Co. and his business partner David Guy, also from Leithner & Co. Chris, I would characterise and his team as a contrarian thinker, and also someone that does a lot of great in-depth research and analysis before he shares his thoughts. So I always enjoy reading and learning from Chris each time I read his articles. Or any of the other information that he shares with ASA members as a regular contributor to our equity magazine. Today's topic is all about today's valuation and tomorrow's returns. And I'm just going to increase the screen here so everyone can see the slides as we go through in big screen format. We're also going to talk a little bit about dividends and go into a bit more detail about dividends towards the end of the presentation. And as always, we encourage your questions. So if you've got any questions as we go through, just go to the bottom of your Zoom box there, and you can see the little Q&A section. Just type any questions you've got into the Q&A section as we go through, and we'll try and get to as many of the questions as we possibly can towards the end of the presentation. So with that, again, thank you for joining us. It's being recorded, so if you can't join us live, you'll hopefully be watching the recording. And with that, I'm going to hand over to David Guy from Leithner & Co. to kick off the first part of today's presentation. Over to you, David.
Thanks a lot for that, Stephen. And welcome, everybody. It's a pleasure to have a bit of a chat to you today. I'm just going to do the really early part, a bit of background on who we are. And then Chris will go into the more substantive part of the presentation. So it should only be 5, 6, 7 minutes for me, and then a fair bit longer time with Chris. So that's what we call ourselves, wealth creators and value investors. As Stephen's outlined, basically, we've got a view generally that returns go back to median returns. So they revert to the mean. That's what Chris will be talking about. So our results, I'll do today's valuations, and then what today's valuations mean for future returns. As Stephen did, we've got a disclaimer there as well. Generally speaking, these disclaimers are just saying don't go out and use what we've said as purely education material to go and trade on effectively. So listen, take it on board, ask questions, but don't go and slavishly follow anything that's mentioned. I don't believe we'll cover any specific stocks today in any event, so we should be fine, but that's the background there. Overview, we'll give you a bit of a view of our long-term returns. In light of the past, what do the present valuations tell us about the future returns? Given these inferences, how have we prepared? We'll have a bit of a sideline on dividends. In some ways, they're poo-pooed by the market, but they're a fundamentally important part of your overall return. And then we'll do a bit of a comparison with Berkshire at the end. We certainly invest in a manner that follows Ben Graham, which is who Buffett started out following as a student of his. So we have some similarities there. And then, as Stephen mentioned, there'll be enough time at the end for a bit of a Q&A. So this is an interesting one. We've been going for a fair while. We started in June 1999, so it's over 25 years now. It's a long time, but it also means we've got a long-term track record there. Generally speaking, we've kept up with the market. If you have a look at that, our returns are the red line, and the blue line is the All Ordinaries Accumulation Index. And these are compound returns, which is important. If you have a look at it, the only previous time to now that the market generally outperformed us was right in the lead up to the GFC. And anyone who was around at the time will recall there were problems with the market and with subprime in 2007. But notwithstanding that, the market went on a bit of a tear after that through 2007 and then into 2008. So the market was caught up in itself and kept returning outsized returns, even though fundamentally the economic outlook was deteriorating. We would suggest something similar as the same there. It's similar as happening now. There's an enormous amount of foolishness happening in the market generally, particularly in the US, but we're certainly not immune from it. And we would like to think that we're well placed for what the future holds. And, you know, I'm not saying we're going to outperform for the period we did after the GFC. As you can see, there was a fairly big outperformance there. But I will say that we're conservatively placed and we're in a much better position than the general market. The returns for the last 25 years, you know, we're looking at about 8%, a bit over 8% per annum compound, which is a significant return. If you can compound your money at 8-9% over time, you'll do very well. Just on to the next one there, Stephen. This is what we call, since the COVID crisis, effectively. So it gives you an idea of how we've performed on a more short-term basis. And you'll have a look at the start there. Anyone who was around investing in March 2020, the market collapsed. It literally just collapsed. There were sell orders flooding the system. We didn't bear too bad. We didn't fare too badly in that period. You can see we've had a small fall. I believe intra-month, our biggest fall was probably 7 or 8%. 6 was the month-to-month return negative. The index, conversely, was off the best part of 30% at one point in time. So we've found and we believe that a good part of earning good returns over time is to avoid those losses. If you avoid those big losses, you don't have to make the money back. As you can see, we're a lot smoother. We don't have the dips. If you look more recently, we've started to slightly underperform. And that's a result, again, of animal spirits taking hold of the market and the market rising, in some cases, in spite of the economic outcomes that we're identifying. Volatility is a simple measure. It gives you an idea of how much squiggle, I call it, how much our returns are moving around on a month-to-month basis. Again, where the red line, for the general index. If you look at the maths on it, we're about 40% the volatility of the index, so a lot less. And part of that is on the next slide. Generally speaking, over a long period of time, we've tended to keep cash. If you have a look at it, since we started, we've averaged 52% of our assets in cash. At the moment, touch under that, I think we're about 49, 50%. But basically, that means we've got 50% of our entire assets sitting in cash. The rest's working there in equities generally, but we've got a solid base of cash. Chris will go through it later. We don't believe that's hindered, as we've seen previously, our returns. And in fact, it tends to be the thing that gives us the ability to outperform over time. We have cash when the market falls dramatically. We're sitting there buying. We're not the people who are getting afraid when the market falls. We're the people who are steadily going to work and buying things. So, you know, it's very important from our perspective to have that cash. We're very comfortable with where we're placed if things tend to deteriorate over the short and medium term, as we expect. I might hand over to Chris, and he can move forward. If there are any questions at the end, I'm happy to answer those, and I'll pass over to Chris.
Okay, thank you, David. I'll start with two foundations, both for today's presentation, but more generally, how our company strives to operate. And I've taken a quote to summarize it. Factfulness, which technically I don't think is a word, Hans Rosling invented it. It's the habit of striving to base everything you say and do upon strong supporting facts. It astonishes me, perhaps at my age it shouldn't, but it still does, how often in financial terms and on financial markets, people say things that simply are not factually based. They're simply wrong. They're strongly believed, and yet the evidence simply isn't there. I'll give you an example, a fundamentally important example. But as a first foundation, there you have it. All the points I want to make to you today, I've assembled the strongest factual basis I can for it. And more generally, that's how Leithner & Co. operates. So that's the first foundation. Next slide, please, Steve. Our second foundation is a quote from the Royal Swedish Academy of Sciences. You can read as well as I can, but the crux of it is there's no way to predict the prices of stocks and bonds over the next few days or weeks. And I've added parenthetically over the next several months or even the next year or more. I've written quite extensively that the returns of stocks on a short-term basis, that's to say up to 12 months, are purely random. And because they're random, they're unpredictable. So that's point one. But point two is that it's quite possible to foresee the broad course of returns over longer periods, such as the next 5 years and beyond. What basically happens is that in the short term, over a 12-month period, noise overwhelms signal. But over a longer period, the medium term, 5 years, long term, 10 years and beyond, the noise cancels itself out and a stronger and stronger signal emerges. And that's the guts of findings that the Academy recognized, particularly in the context I'm putting it, Robert Shiller for its award that year. It's commonly called the Nobel Prize in Economics. Technically, it's not that. I'll leave that aside. Good. Next slide. Steve's ahead of the game. What I've put together here is a messy slide. I've tried to simplify it. Doesn't quite simplify, so let me give you a chef's tour. We've got two squiggles on the line. Both squiggles are 5-year CPI-adjusted total returns. That's to say CAGRs, compound annual growth rates. Since January of 1974, one of the squiggles is for the All Ordinaries Index. The other is for 10-year Commonwealth bonds. They're 5-year compound returns. They're net of inflation. That's what CPI adjusted refers to, and their total returns. That means it includes dividends in the case of stocks. It includes payments of interest in the term of bond in terms of bonds, and that's over basically the past 50 years. The point I want to raise with you or draw to your attention is that the all ordinary squiggle is more or less horizontal across the page. The trend line is very slightly downwards, but statistically it's on the threshold, and substantively, I don't think it's significant. It's influenced by the huge, strong returns just before the 1987 crash. What it tells you is that the returns of stocks regress to a mean. The mean being, and my glasses can't quite see it, I think that's quite, or non-glasses now, 7.3% per year. The higher they rise above that, the more they subsequently fall back towards 7.3%. And the lower they fall below it, as they did in the early 1990s recession, during the GFC and so on, the more they tend to push upwards. So just as Icarus soared to the clouds and then crashed to the ground, so too Phoenix rises from the ashes. When it comes to stock, what rises subsequently falls, what falls subsequently rises. With bonds, however, it's a very, very, very different picture. The trend line is one of basically rising throughout the 1970s, 80s, peaking in about the early to mid 1990s. And since then, it's been all downhill. The most recent returns on a 5-year compounded total return basis are minus 6%-ish, something like that. So just bear that in mind in the rest of my talk. With stocks, we're talking about a return that rises and falls, but has a rough average. Very different with bonds. Okay, next slide. Given what I've said, that the returns of stocks regress to a mean, which is something that Robert Shiller found and for which he was awarded, I want to unpack something called a cyclically adjusted price to earnings, known as a CAPE ratio. Most of us, or most people listening today, are going to be quite familiar with a standard price to earnings ratio. The price is the numerator of a simple fraction. Whether it's the price of a stock, it's the level of a market. And the earnings, that's the denominator, that will be, say, the earnings per share of a stock. So if a stock is selling for $10 and it earns $1 in the most recent 12 months, then its PE ratio is 10. Robert Shiller devised the CAPE ratio. Ben Graham originated it. He originated the idea in Security Analysis, a book he wrote back in the 1930s. The problem he identified with the PE ratio is that it varies a bit. Why? Because earnings can be quite volatile from one year to the next. What Graham basically recommended in Security Analysis, and I think he mentions it in The Intelligent Investor, is that a better PE ratio takes the average of earnings over several years. My recollection in the two books, he nominated 7 years. Robert Shiller took 10 years. And more than that, CAPE adjusts those earnings in the denominator for inflation. So it removes the effect of CPI. So in my second square there, CAPE equals the price of a company or an index, that's the numerator, divided by CPI adjusted, the 10-year average of CPI adjusted earnings, that's CAPE. Shiller has calculated the S&P 500's CAPE since 1881. I've done the same thing for the All Ordinaries since 1947. And the crucial point is that valuation matters. We can use CAPE to project future earnings over an extended period, 5 to 20 years. In today's talk, I'll do it over the next 5 years. The higher is the current CAPE, the lower tends to be future returns, and vice versa. But the crucial point I want to draw to your attention in that fourth square, and I'll elaborate it as we go through, valuation does matter. Buying low CAPE stocks puts odds on your side. Buying high CAPE stocks puts the odds against you. Buying into high CAPE markets generally puts the odds against you, and vice versa. Okay, Steve's again ahead of the game. Here are the CAPE ratios for both the All Ordinaries Index and for the S&P 500 since 1947. The biggest discrepancies between the two, you can probably see, occurred during the dot-com bubble when the S&P 500's CAPE soared above 40. That was the first discrepancy. And the second one is since the GFC. The one for the All Ordinaries has risen in recent years, but not nearly as much as the one for the Standard & Poor's. The current CAPE in Australia is something like 22.5. It ranks among the top 5% since 1947. The current CAPE in the States for the S&P 500, that's for October, is 39.5, and that ranks among the top 2%. Now, critical point, which I should have made by now, I'll make it again, or let me emphasize it now. High CAPEs don't signal, the critics often are misconstrued. High CAPE doesn't signal that a crash or a downturn is imminent. It does signal that lower returns are in the offing. So I'm not saying that there's a crash or a bear market or a down, anything like that. What I am saying is that this is a signal of lower returns. Next slide, please. What I've done for both the All Ordinaries Index and for the S&P 500 is to take each index's CAPE since 1974, so we can directly compare apples with apples. I've ranked 5-year CPI adjusted returns, total returns, according to CAPE from the lowest to highest. And then I've chopped the sample into 5 equal portions. That's what I refer to as Q1, Q number 2, Q number 3, 4, and 5, pardon me, at the bottom of the graph there. The Q number 1 is the lowest quintile. That's those 20% of observations since 1974 when CAPEs have been lowest. And Q number 5 are the 20% of observations since 1947 when CAPEs have been highest, both in Australia today, or for the All Ordinaries Index, and in the States today for the S&P 500. Both of the current CAPEs rank in that top quintile. And more than that, there are a smallish number of cases in the States, none in Australia, but in the States, what happens when CAPE is above 35. So this is the guts of our expectation for the next 5 years. When I compare what happens when a current CAPE has a particular value, we can use past data to project into the future. I simply say, what's the average CAPE for the next 5 years? For both the All Ords and the S&P, it's something like 2.5% CPI adjusted. But in the case which applies today for the S&P 500, when it's above 35, which it is, the average rate of return, compound rate of return, is -4%. So that's 4%, -4% times -4%. That's basically 0.96 raised to an integer of 5, which is something like a 20% loss, is the projection. One more caveat before we proceed. Quickly, flip back just briefly, Steve. Each of these quintiles contains something like 125 observations. Within that, there's a decent amount of variation. I've taken the mean, but I'm emphasizing there is variation around that mean. Do my results guarantee compound annual returns of something like 2.5% for the All Ords for the next 5 years? No, of course they don't. They're simply saying that the mean is the most likely observation. So that's what the odds are telling us. But things can defy the odds. The return could be higher, could be lower. But what I'm emphasizing are means. Okay, next slide, please. Okay, first conclusion. Preliminary conclusion, if you like. The valuations of both Australian and US stocks are presently, in Australia, very high, in the United States, very, very high. Valuation matters. It matters for value investors. High current CAPEs have tended, I emphasize the word tended, to get below average returns over the next 5 years. Nothing's written in stone, no guarantee that's going to continue. But for the bulls, as is always the case for the bulls, it has to be different this time, because if it ain't different this time, they're in a pickle. Hence comes the question, and bearing in mind the disclaimer that Stephen made at the outset, that David did as well. What then to do? Our first response, Leithner & Co.'s largest allocation, our target allocation to equities, as it always has been relatively low. If stocks generally are dear, we're certainly not going to jump overboard buying stocks. Secondly, though, that's the square on the rightmost side. We hold and seek to acquire low CAPE stocks and avoid high CAPE ones. That graph 1 or 2 slides ago, it was for markets as a whole, but it, broadly speaking, applies at the micro level. That's to say to stocks. You buy high CAPE stocks, your return is going to tend to be low. You buy low CAPE stocks, your return is going to will tend to be high. So we're 2 things thus far in terms of my conclusion. What Leithner & Co. is doing, we're definitely not going overboard. That's 1. 2, we're looking for, and where we can find them, buying low CAPE stocks. Okay, next slide. Conclusion 2, remember the point I made about the Commonwealth 10-year bond? Its adjusted CAGR has been falling since the 1990s. It's been negative since 2022. And in September, it was -6.6%. That's close to a 50-year low. When's that generational cycle going to turn? I don't know. I don't think anyone knows. The RBA doesn't know. Hence point 3 there. We are steering clear of bonds as opposed to bills, short-term instruments. We're accumulating short-term instruments, but steering well clear of bonds. Next slide. David's slide, when he showed our asset allocation, we've showed it in the past. It often surprises, amazes, disturbs some people, saying, "You're nuts. You hold far too much cash." As I've said, a lot of people make claims based upon a lack of evidence. What we're doing is emulating Berkshire Hathaway. We don't emulate them in the sense that we apishly follow every move. We buy what they buy, we sell what they sell. Not at all. Our holdings are totally different. We're invested in Australia, not in the States. But what we're broadly speaking is following what they've been doing since we've been in business. Point one there, since 2000, Berkshire's total assets have comprised an average of 25% cash and bills. It owns very few bonds, 27% listed equities, and almost half, 48%, of majority or wholly owned businesses. Notice then that their allocation to cash and their allocation to listed equities is about the same. They hold as much cash as they do listed equities. That's exactly the same as we've been doing. Third point, Berkshire and we at Leithner & Co. have acquired stakes in major, well-established businesses in vital industries which possess long track records of profitability and whose shares sell at a discount, according to CAPE and other conservative valuation methods, conservative assessments to their values. Next slide. This simply quantifies what I've said before. I've done what apparently no one else does. I've looked not just at Berkshire's balance sheet, but I've looked at it on an annual basis for the past quarter century, and I've divided it into three strata. The percentage of their total assets comprising cash, bills, and bonds. The second one is listed equities, and the third one is other, which is namely partially or wholly owned subsidiaries. Notice that the cash percentage has jumped massively between 23 and 24. That's largely as a result of selling its colossal stake of Apple shares. Since then, according to quarterly reports, its cash holdings have risen again. But the point being, we're emulating Berkshire. We at Leithner & Co. are emulating Berkshire in the sense that we follow the same underlying principles. We apply them to Australian conditions. We don't ape what they do. We don't buy what they buy. We don't sell what they sell. So when people say, oh, your allocation to cash is way too high, that's crazy, you're missing out, blah, 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 I say, you're simply ignorant of Berkshire Hathaway's balance sheet. Next slide. Okay. Factfulness. Back we go to factfulness. I want to justify what we do and why as strongly as possible on the basis of actual facts. And what's often the case, this is my example of what is conventional wisdom is often absolutely dead set wrong. So what everybody knows within quotations, the conventional wisdom about dividends is that the lower a company's payout ratio, the lower its total profit that it pays out as a dividend. Says the conventional wisdom, firstly, the higher are its retained earnings and the more it can invest. That's a truism. I'm not criticizing that. Point two, the more it invests, the more it increases its profits. We'll see that that's basically false. And point three, the more it lifts its profits, the higher will be its total return. As we'll see in just a minute, that's simply factually false. Next slide. What everybody knows, the conventional wisdom, the lower is a market or a market index's current payout ratio, the higher will be its future earnings and returns to shareholders. And for that reason, says the conventional wisdom, investors should therefore seek companies which retain and invest all of their earnings. They'll outperform dividend-paying blue chips. That's what everybody knows. Allegedly, that's the conventional wisdom. It's dead set wrong. Next slide, please. The conventional wisdom isn't just incorrect. It's the polar opposite, diametric. It's wrong. It's 180 degrees wrong. What I'm about to show you is that the higher is a market's, and by inference, a company's payout ratio, the higher will be its earnings and returns to shareholders. Notice I'm using the future tense there. The higher will be its earnings and returns to shareholders. Next slide. What I've done, I've taken Robert Shiller's data that he originally put together for his book, Irrational Exuberance. And for each month since January of 1876, I've done for the Standard & Poor's Index 4 things. I've computed its dividend payout ratio, its rate of change over the preceding 5 years. So if it's gone from 25% to 50%, I call that a 50%, sorry, that's a 100% increase. Secondly, I sort these and other relevant data by the ratios change. Divide the data into quintiles. That's similar to the slide several back with the CAPE ratio, 5 subsets, which roughly equal numbers of observations. And then I computed various statistics for each quintile's observations. In other words, we haven't taken the conventional wisdom as writ. We've conducted our own analysis. And the next slide shows the results. This is a messy slide too. There's a lot of things going on. Let's just look at it one column at a time. The first column distinguishes through the rows quintiles 1, 2, 3, 4, and 5. Remember, each quintile contains a roughly equal number of observations. Quintile 1, that's the lowest payout ratio. The average is 50%. And notice as you read down the column from quintile 1, 2, 3, 4, 5, the payout ratio rises. Okay, that's exactly how I've sorted the data. That shouldn't surprise anyone. The third column, notice that that's referring to the previous 5-year compound annual growth rate of earnings. And notice that this, in a sense, or in a strong sense, supports the conventional wisdom. As your payout ratio rises, the rate of growth of earnings falls. It falls from an annual rate of 11.6% per 5 years, 4.7, 1.8. There's a bit of a blip there, and then it falls. All right, so the higher is your payout ratio, but notice PREV, those are the previous 5 years' earnings. Next column over, if we looked at the previous 5 years' earnings, oh, sorry, previous slide, beg your pardon, there we are. The next 5 years' earnings rate of growth is the polar opposite. It goes from a minus 2.0% to a strong rate of growth. Okay, so those two columns, previous 5-year earnings, next 5-year earnings, they both have to do with earnings. Then the two most columns on the right-hand side have to do with total returns. That's to say, stock price growth plus dividends. The previous 5-year total return does indeed fall. The conventional wisdom in that sense is right. As the mean payout ratio rises, so too does the rate of total return from 8.77659, and it falls. But critically, that's the previous 5 years rate of return. The next 5 years total rate of return rises. 5.1, 6.3, 7.9, 11.3. The next 5 years total rate of return is highest when the mean payout ratio is also highest. Next slide. What's going on here? There's two complex patterns going on, but basically companies flush with retained earnings tend to squander them. There's a biggish literature on this. The conventional wisdom in this sense is just wrong. They grossly underestimate the extent to which, well, just that. Companies flush with retained earnings squander them. Companies which pay hefty dividends have fewer retained earnings to squander. In other words, those companies are utilizing their retained earnings much more rationally by paying dividends rather than squandering them on takeovers, blah, blah, blah. The second point then, the inference, one of the best times to buy an index or one of its components, namely companies, is when some event has smashed its earnings and caused its payout ratio to soar. This is a real-life example of the point that I made about, well, we buy large, well-established companies when they run into trouble. Companies are loath to cut their dividends more than they have to. The earnings might fall, but the dividends don't fall as much, meaning that payout ratios rise. Next slide. Crucial point. If you look around, you'll find we're certainly not the only ones who've uncovered these crucial facts. It's been around a fair while, but people either don't want to know or have forgotten. Quote, in one of the most surprising research developments over the past 4 decades, says Robert Arnott, of the past 4 decades, 2 authors, Robert Arnott and Cliff Asness, have published an article. It's now pushing a quarter century ago, and it's entitled Surprise, Higher Dividends Equal Higher Earnings. And that's the quote is by Stanley Block, who's a bit of a counterpart to Steve. He was at the time the head of the American Association of Individual Investors. Next slide. The evidence is overwhelming. William Bernstein has passed away, but was for decades a well-respected investment researcher, wrote a very, very, very good book about investment risk. The evidence, he says, is overwhelming. He wrote in the Wall Street Journal a quarter of a century ago, on average, $1 of earnings reinvested in the company benefits the investor a good deal less than $1 of earnings distributed as dividends. That's to say, you're better off receiving a dividend than you are keeping the money retained in a company. And the next point, which is the crescendo, the reliable return attributable to dividends, says Robert Shiller, or said Robert Shiller in Irrational Exuberance, not the less predictable portion arising from capital gains, is the main reason why stocks have, on average, been such good investments historically. I hope I've not told a lot of Australian conservative investors, I hope I've not told them anything they haven't heard before. They know full well that dividends are important. They know full well that they've profited from them, that their returns have been underpinned by dividend. But there's a lot of nonsense out there from so-called experts who say otherwise on the basis of their opinion, as opposed to actual facts. Next slide. Here are my conclusions then, before we go into a Q&A. Our analysis, notice the word analysis. I've said nothing, I hope, that I've not been able to substantiate, not just with analysis, but with our own analysis. Our analysis indicates that equities are highly priced and that over the next 5 years, it's unreasonable to expect more than single-digit CPI-adjusted returns. I'm not talking about a crash. I'm not talking about a bear market. I'm not talking about anything. I'm simply saying, on the basis of past evidence, it's simply unreasonable to expect more perpetual economic sunshine. It seems to me that seldom is it different this time. We've got to go on what the past has told us. We can't automatically assume, we should seldom assume that it's different this time. And that's what the past is telling us. Conclusion 2, bonds as opposed to cash and bills remain very risky based upon their medium-term 5-year compound CAGRs, return rates, which are very much in negative territory. It's at 50-year lows. Therefore, point 3, conclusion 3, we at Leithner & Co. seek to hold and acquire A, low CAPE stocks, and B, reliable payers of dividends, and to acquire them at higher payout ratios. The most important point I think I can leave with you, my conclusion, based upon our research, is that over very long terms, we're talking about 20 years, 30 years, and beyond, value has and will continue to outperform growth. That's the guts of it. Last slide is our Q&A slide. So David and I are both quite happy to take questions.
Wonderful, Chris and David. Thank you. And apologies for a couple of quick forwards on the slides there.
Yeah, not at all. You did very well.
We didn't do too badly. So yeah, a reminder for everyone, if you've got some questions now for Chris and David on those important topics around valuation, reversion to the mean, dividends, now is your chance. Just head to the little chat box or Q&A box at the bottom of your Zoom screen and type in your questions as we go through. So I'm going to kick off with the first one, Chris, just kind of a general open question here. I'm guessing you've thought about this a lot. Why do you think it is that the industry or, finance professionals, so to speak, do get this wrong so much? Why are they so overconfident, do you think, or don't look at facts or evidence enough, in your humble opinion?
In my humble, this will be an opinion as opposed to facts, but off the top, well, more than off the top, mate. I have thought about it. I can't give you overwhelming comprehensive evidence, and I'm not a psychologist, but it seems to me that a lot of people want to tell other people what they want to hear, that returns are easy, profits are easy, buy X today because it's going to go up by X% in the near future, and you can get rich quick. And the odds of getting rich quick are very, very low. The odds of becoming financially independent, but slowly over the course of decades, the odds are on your side. But the odds of getting rich quick are very small. And I use this example. I gave a talk to the ASA on the Gold Coast. There's a casino on the Gold Coast. There's a casino in Brisbane, Sydney, Melbourne, you name it. In Australia, there are casinos in big cities. And if you, as an individual, N equals 1, just one person walks into the casino, the odds are, with $1,000 or whatever it is, the odds are that you'll walk out of the casino with considerably less money. But there is a chance you'll strike it rich. And part of the answer to your question is you can virtually always point to, quite correctly, to look at that person who bought X Limited at $1 and it's now $3. He got rich quick. You can do so too. Let me now give you a second point. It's not one person who walks into a casino, but let's say a group of 100 people walk into a casino and they do their thing. Each of them have their $1,000. It's still possible now in a group of 100, I'm just pulling this out of my hat, it's possible for the sake of argument that 10 of them will have done quite well. And they're going to be bragging about the fact that, look at me, I really know what I'm doing. I beat the blackjack table, I beat the roulette wheel. Now, I'm not denying the fact that whatever it is, 10 might have done quite well, but here's my point. The bigger is that group of people who walks into the casino, the greater are the odds that the average the average result is a loss. Take one person's gain, offset it with multiple people's losses, and on average, they're going to lose. So part of the answer as well to your question is a bullish funds manager or whatever it is, newsletter writer can always point to that minority of people. Oh, look at Fred Bloggs who bought Bitcoin at $1,000 and it's now $100,000. And there he is on his own personal island, on his own personal yacht and so on. There's always going to be those examples, but it overlooks the case that the majority of people who go into get-rich-quick schemes, alas, are going to emerge with losses. And it overlooks the fact that really conservative, justifiable investment is boring, and frankly, it should be boring for people who are rearing families. Your kids are important, and your spouse is important, and minding your folks is important, and doing the right thing by the neighbors and so on. Over the course of decades, if you do it properly, you emerge with a nest egg that will finance a reasonable retirement. Perhaps there's something left over for the kids. Perhaps there's something left over for charities and so on. But honestly, that's boring. And most people want to be excited rather than bored. The cost, of course, is that if you do exciting things, you're going to get your comeuppance. That's, I think, at least part of the answer to that sort of a question, Steve.
Yeah, no, good answer, Chris. Thank you for sharing. And again, that's one of the reasons we love working with you at ASA, because you're doing a lot of really great deep thinking and deep research and studying markets and studying facts that you share with us. So we appreciate that. We've got a couple of questions coming in here from an anonymous attendee. It might be Robert Schiller, actually, because I've got a question on CAPE just to test your knowledge. So the question is, I get that a low CAPE is good, but do you also look at what is happening to a specific company? For example, a company that's in an industry that might be in structural decline will have a high CAPE in its sunset years.
I'll answer the guts of the question, which is to say, do we look at company-specific factors? And the answer emphatically is yes. Simply because a CAPE is low. In other words, we're not sort of one indicator. We're not one-trick pony sorts of analysts. An indicator is just that. It indicates something. Exactly what does it indicate? It could indicate all manner of sorts of things. It could conceivably be that CAPE is low for a very good reason, in the sense that, well, its structural decline was mentioned. So the short answer is that is an indicator, but still we're very much Grahamite. We go through the financial statements, balance sheets, P&L, and so on. There's lots of other things we look at. So if you think in terms of a screen, that the CAPE would be, if you like, the first screen, but there'll be lots of other screens or filters, if you want to call them, through which things have to pass. So that's an excellent, I overlooked, if you like, in my presentation, I ignored the subsequent screens. I only looked at the first one, but there are plenty of others. And so the question is quite right about that.
Okay, very good. We've got another anonymous question. They say, you want to avoid duration risk in bonds. Can you please let me know what's your cutoff for duration risks, i.e. is it less than 5 years or 3 years or just money market credit? And how would investors beat inflation if we just had to rely on cash in the debasement era predicted in the future?
The short answer is regarding duration risk. We don't particularly, I've looked at, call them bills, 3-month instruments. I've looked at bonds because they are not in an Australian context, but in an American context. That's, if I can put it in this way, they're sort of the thermostat of the world's financial system, but there is a colossal range, if you like, between 3 months and 10 years. I don't dispute that. We're ultimately not bond people. That's not a speciality. We're much more interested in companies, that's to say, equities. So the short answer to the question is we don't look at duration that much. That's point one. Inflation was mentioned as part of the question. Yes, we live in an inflationary age. Even so-called moderate inflation of 2.5 to 3% a year, compound that over 10 years, and it shags close to a third of your purchasing power. So in that respect, the one reason that bonds did so well up to the mid-90s is that the Federal Reserve in the States from the late 70s into the mid to late 90s took a sledgehammer to the rate of inflation. And 30-year bonds that were yielding double digits, 12, 13, 14%. You did as well by reinvesting those than you did. So yes, obviously, the results of bonds are going to be tied to inflation. That's particularly true, has been particularly true when inflation was colossally high back in the late 70s to early 80s. We lived in an inflationary age, but we don't yet live in anything remotely approaching the inflationary age in which we lived in the late 70s, early 80s. The economy is much more globalized. Trade unions in places like the States are much less, in the UK, much less powerful, prevalent, and in Australia too, apart from some sectors, much less prevalent. So the ability to hike prices in a much more globalized world is much less, it seems to me. I'm oversimplifying clearly. So I'm by no means discounting inflation risk. It's there. But there's a mammoth difference between living in a world of roughly, call it 3% inflation, as opposed to 12% plus, which was a generation ago. So I hope that helps a bit.
I think it does, Chris. So the crux of the tail end of that question, though, I think kind of went to how much you might be holding, or Berkshire might be holding, for example, in cash-like instruments. So
Yes.
how I guess the question there is really how do we manage as investors this environment that we're in, where inflation is an issue, and maybe
Yes.
your cash or your cash-like instruments aren't getting you the rate of inflation.
Okay. Now, I can answer for Leithner and Co. I can't answer for individuals. Our cash doesn't just serve double duty; it serves treble duty. Obviously, whatever, let's just say it's at call cash, it receives a rate of return. So that's one duty that it's serving. And the question is quite right. Adjusted for CPI, it's not a high return. Okay, but that's one duty. Duty number two is dry powder for market downturns or company upsets. Suddenly, company X becomes available at a price that happens to us, crudely speaking, once or so, twice a year. We've done all of our research. We know the price we're prepared to pay for it. We think we know the company reasonably well. And then it falls by whatever it is, 25%, 30% because of X, whatever X is. And we say, well, we think X is an issue which you can manage, it can sort itself. It's going to take a couple of years, but that's a cheap price. So our cash is serving that second duty. It's sort of a free option. And related to that, though, because we do write a fair few options, particularly puts, our cash plays a third role. Because we're very conservative people, we don't want margin calls. And I'm oversimplifying, but both brokers and the ASX oblige us to put up collateral for our derivatives / options operations. But above and beyond that, we always have at least as much cash available, so that if all of our derivatives are exercised simultaneously, that's fine. We take delivery because they're put options. We take delivery of the shares because we have the cash there. The cash collateralizes all of that. So the cash is doing not just two, but three things. That works for us in a way that I don't think it would work for an average, normal, middle-class Australian investor.
Got it.
In other words,
Okay.
in that sense, it makes sense for us. It could make sense for us to hold more cash than it does for an average, normal, middle-class Australian investor.
Sure. Did you have a comment there, David?
Yeah, just one. I think it's important to make the distinction between cash and cash-like as well. Particularly in my experience, people tend to lose more money in cash-like products than equity markets.
Yes.
And the reason is we're all trying to get higher returns, but we're also all aware markets are high. So we take cash, but then we don't like sitting on cash. So we just start to broaden out our risk tolerance slightly. And I'm mainly focusing on the flood of private credit offerings that are out there. To me, this is exactly the same as 2006, 2007, when there were all mortgage trusts. We all know the stories, City Pacific in Queensland, there's a bundle around the country. That's all this is. Private credit is crappy loans to property developers. That's basically it. So the risk, the biggest risk out there is moving out on the risk quotient on cash-like products. So from our perspective, cash is cash. We're talking Australian banks. We're talking theoretically government bills, that sort of stuff. Term deposits is probably as much as we go out in terms of duration. So you don't want to do the right thing by raising levels of cash by selling out of things, and then to get an extra 100 basis points or 200 basis points, take a big risk, because the risk on these things, these private credit type stuff, any of the previous examples of it, the risk is that at one day your investment's worth $100,000 and the next day it's worth zero.
Yeah, so that was a good segue, actually. We had a question from Henry Stevens about what were your views on private credit and is it a highly risky sector? So I think you answered that one. I've got a follow on there, though. What, if anything, have you noticed from the private credit sector in terms of how they, and I'm not talking about any specific company here, but just how that part of the industry is marketing at the moment, the kinds of things that they're saying to possibly attract those that might be wanting to put their cash to work. Have you kind of noticed any trends or things there that people should watch out for in terms of the way they're messaging?
Look, they do what people have always done over time. They put an interest rate on something, and the minute an interest rate's put on something, whether it's 8 or 9 or 10%, people fixate that. They get it stuck in their mind, and it tends to equate to a term deposit type scenario, which they're just not. They are not. ASIC came out yesterday, I believe, and said there are fundamental problems with private credit where they're not recognizing losses. And we find this in every market cycle with these type of environments. And there's a good saying I like, which is what these guys do. A rolling loan gathers no loss. So if they have a loss on a loan they've made, they tend to roll it. They'll roll it into a bigger loan, so they don't then have to declare the loss. And that's what allows this thing to continue until, as I said, eventually one day you wake up and you haven't fallen 10% because the market fell 10%. You find out the whole thing was smoke and mirrors. So yeah, private credit and the floods of money. There just aren't that many, attractive investments out there. The problem is the same problem we've always had lending to property developers. We focus on, it'll be sold as first mortgage security, but it tends to be first mortgage security on end value of the property. It's not first mortgage security covered on the actual purchase price of the block. And the problem we've got at the moment is you can't build a house. Can't build a block of units. Lend Lease, I think, came out and said we get 2.5 days of work a week in Queensland. You can't build things for the price people expect to build them for. So there will be a problem. When, how, I'm not sure. The other little daisy chain that's happening out there is the AI. We've got NVIDIA lending money to companies to buy its own chips. It might be reinventing the wheel, but I doubt it.
Very good. Thanks, David. Few more questions to get through still. So Philip Frankiewicz asks whether you could give an opinion on crypto and stable coins and their place in the investment world, particularly with future returns and cash returns not beating CPI increases. So any thoughts on one of those other new sectors in crypto and stable coins? I know it's not probably your core strength, but just any general thoughts, or if not, that's okay.
I'm happy to flick that to David if he wants to say anything.
Yeah, look, Stephen, it's not our area. We don't invest in it. There is a big difference there. There's a massive fundamental difference between crypto and stablecoins. Stablecoins are generally designed to be backed by something, whether that be US dollars or whatever. So crypto is a bet. It's effectively a more, greater fool theory. You're effectively assuming you're going to be able to sell it to someone else down the track. Stablecoins, if they're genuinely backed by, US dollar. Let's look at a US dollar stablecoin. If it's genuinely backed by US dollars, if you can get around the risk, basically the technology risk of where your actual asset's sitting, you then come to a scenario of, why would you invest in a stable coin linked to US dollars rather than just US dollars? If they're offering a higher return than US dollars, how are they offering a higher return than US dollars on something that's linked to US dollars? So you've got two scenarios. The stable coins, I don't think, are as dangerous other than the potential for fraud risk. But why would you bother with them? And in terms of crypto, you are making a bet that you can sell this thing to someone for a higher price down the track. And you may well, and people have, no question.
Sure.
But that's what you're betting on.
Yeah. Okay, very good. Chris Meakin says, thank you for a very informative talk. Each month, Schiller publishes his data on CAPE and excess CAPE yield for the S&P 500. And Chris downloads and charts Schiller's version of excess CAPE yield. He was interested in being able to chart an ASX version of CAPE. So do you know if that data is freely available anywhere?
The short answer is I don't. We've simply analyzed our own data. So, but whether it's available elsewhere, I've not seen it. My guess is no, it's not, which is just goes back to one of the points we made. We do our own analyses. We double check, we treble check. So I think the answer to that question is no. But I could be wrong, but I've certainly not seen it.
Yeah, I'm just doing a quick Google search on the fly here. There is a US-based manager called Meb Faber, M-E-B, first name Faber, F-A-B-E-R, and he does publish, last time I looked, he was publishing CAPE for the indexes, like the ASX 200, for example, for about 30 countries around the world on a quarterly basis. So if you're interested, Chris Meakin, maybe look up Meb Faber and his company, and see if you can still get the ASX quarterly CAPE info from there. That's the only one that I'd ever come across. Douglas Scott Maxwell asks, what portion of your equities are ASX listed, and what's your opinion on dividend growth investing?
David, do you want to handle that one as well?
Yeah, basically 100% of our equities are Australian. The only exception to that is, for instance, we held Westfield shares that got merged with Unibail, and then now getting off the ASX and moving to Euronext. So we will endeavour to hold the Euronext shares because we still think it's good value. But that's what tends to happen. So takeovers are the thing. Otherwise, we're just in Australian shares. Okay. Sorry, there's the second part to that.
And then the dividend growth investing was the second part of that question.
Yeah, I mean, it's just a different way of doing things. So what we do when we value companies is we tend to move forward 5 years. So we'll work out what company is going to earn over the next 5 years. Some of the models we use will be incorporating dividend, or all of the models we do incorporate dividends. So a dividend growth will just be calculated backwards from what we expect to earn over the next 5 years. It's a very helpful thing. If you've got a company that is growing its dividends, it's, as we've said, dividends are important. Growing dividends are, a very, very attractive thing to have, particularly, well, only if they're backed by underlying earnings. But yeah, the model's not wrong. But models themselves aren't wrong. It's just the inputs you put into them and the takeaways you take out of the outputs. They can be wrong. So.
Sure. Okay, and then final question from Henry Stevens. Henry asks whether you've got any thoughts on subordinated bank debt in Australia at the moment.
David,
Yeah,
you
I'll
go
have a crack
ahead.
at that one too.
Yep.
There's a bit of an issue. I mean, APRA seem to have got themselves. I don't know what they're trying to achieve. They're getting rid of bank hybrids, and people have sat on bank hybrids. It's been a solid market. It's a market I don't think structured correctly. I think they were probably a positive thing for capital markets. But we're moving away from them. I think bank subordinated debt can make sense. I think the big four and probably the large regionals in Australia are, protect sacred cows. They're not going to be allowed to fail. The question then is how far down the capital structure a problem would be. Banks will have problems going forward. Our banks are incredibly highly valued because they are basically building societies. They lend money to property, let's call them investors. So there will be a hiccup at some point in time. The GFC occurred because no one could fundamentally accept that US property market, residential property prices could go backwards. That was the underlying basis of the GFC, was that no one believed that underlying US property prices would fall, because they never had. If Australian property prices fall over a period of time, we could have bank capital problems. That's your problem with subordinated debt on banks. You are getting a higher return because you are taking a higher risk. Fundamentally, I don't think that risk is massive, simply because I don't think that banks can be allowed to fail in Australia. They will be bailed out. But you should be aware of that. You are taking that risk.
Very good. Well, look, it's been a fantastic presentation and discussion. We got some great questions there from members, and appreciate both your facts and your opinions. And as always, thank you very much for the contributions that you're both making to ASA. We love reading your regular thoughts in equity, and hopefully, if you haven't met the guys in person, they will be back at our conferences next year somewhere as key presenters on our program. So a good reason for you to come to Melbourne or the Gold Coast next year and hear from Chris and David. Thanks again. Really appreciate it, and we'll talk to you again soon.
Thank you,
Thanks a
everyone.
lot, Stephen. Thank you.
Bye
Cheers.
now.
Bye-bye.